Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, February 5th, 2019. In this video, I want to take a look at the long-term charts, longer-term outlook on the top components of the Nasdaq 100. So we'll look at QQQ and maybe the top 10 or so stocks. It is somewhat of a follow-up to yesterday's video. I did published a video for subscribers only that showed the longest-term outlook, long-term charts. We focused on the monthly charts of XLK and about the top 15 or so components. Why XLK? Well, XLK is a technology sector ETF. And as I stated in that video for members yesterday, um, the technology sector makes up about 60% of the Nasdaq 100. So that, QQQ chart will mirror tech. And as far as the broad market goes, it makes up about 20% of the S&P 500. There are 11 sectors in the S&P 500, so essentially 1/5 of the returns of the entire stock market or the S&P 500 comes from just one of their sectors, one of the 11 sectors. So that's pretty powerful. In other words, let me say this another way. It doesn't matter if where utilities go. Utilities can go to zero, and the stock market the S&P 500 could still soar. Utilities only make up a 3.13% weighting in the S&P 500. So although they are a subsector, they don't matter to the returns of the stock market. What does matter and what matters the most is technology. Now, of course, is it possible tech, goes down and the market goes up? Possible, but you don't see that. You can overlay this chart, especially overlay XLK and QQQ, and you'll see the two nearly mirror each other. So now, if you recall, heading into the highs last year, for the days and weeks leading up to the top, this is what we were focused on, and I continued to repeat one thing. I said the market won't break until tech breaks. And when tech breaks, the market will break. And when this wedge right here, this rising wedge, I just color in blue breaks, that's our sell signal. There was. So when tech broke, there was no mistaking it. And that was the start of the correction. It was tech that started the thing, led things down. The FANG stocks, they started going down. And then the other sectors, financial, everything else followed. And so right now, that's where my focus lies once again. There's no doubt that tech is leading this charge up right now. It's a reinflation of the overcrowded FANG trade. Facebook, Amazon, Alphabet, Microsoft, those big five holdings. So we're going to go through the top holdings of QQQ, about the 10 or so. And what I'll do is it'll be somewhat of a follow-up to yesterday's video because I'll focus, instead of the monthly charts, we'll take a look at the weekly charts. And I'm doing that for two reasons. Number one, I feel it is absolutely imperative, even swing trading, but especially in your investing in trend trading, to never lose sight of the bigger picture. I've been hyper focused on the 60-minute charts lately. Wrong on a lot of calls. The developments, they were clean developments. Trend line breaks, divergences, shorting at fib retracements, resistance, things that have traditionally or historically worked much more often than not in the past. But they're just not working now. So the market has been defying. We'll get to the QQQ charts in a second. It has been defying technicals. We've had a couple, several sell signals, trendline breaks. It started to, work out for a little correction, and the market just pushed higher. Um, so I want to say that it doesn't mean that technical analysis has stopped working forever, because I can tell you there are just times where everything trades well to the technicals, whether it's a sector or the broad markets, and there are other times where it doesn't. But let me say this. Let's jump over to QQQ here for a second, and then we'll go there. QQQ, pull up the daily chart. Let's go look at this board here. Just as we started to get some divergences here on the 60-minute chart, we had bullish divergence at the lows on the RSI. We had some bullish divergence there at that point right about here. It got burned through on this final washout move. I highly suspect this is the same thing. Yesterday, the Qs were up strong, and we had the lowest trading volume of the entire year so far. So there was not conviction behind that. This, to me, I believe, is the final thrust. I think it's a combination of short covering, and although I can't prove this, I highly suspect the same folks that were jumping all over, crawling over each other to buy right here at the highs and also to sell at the lows. I think they're the ones coming in now based on the headlines I'm reading. If you recall, as we headed into the lows, uh, as we headed into the highs, I started talking about what would happen on the way down, about the Fed backing off their hawkish stance, coming back to a more dovish stance, which they've done. The economic first see the economic data revised downwards, and then I said as we got to the lows, hey, the economy is not falling off a cliff. The news, the headlines will change soon. People realize that, hey, earnings aren't that bad. The economy's not in that bad a shape. Yes, things have been rolling over, and we get this. But see, that's what I'm getting at is now that's what I'm seeing and reading in the headlines. So I think the people that are buying now are kind of late to the party. And I think that that's pretty much, I have very little doubt, I should say, I'm sorry, very little doubt that that's all priced in the markets now. So again, let's not focus too much on the short term. We will get a sell signal soon. Right now, like I said, I can't get out of my own way with these short-term 60-minute charts not playing out. We're still okay. I think I'll check. I'll check here. Let me see if the Qqq Short Trade is still in play. I just got back from the dentist appointment, guys. So let me check that. Yes, okay. So for subscribers of the site, the current Qqq short trade is still intact right now. They haven't hit our stop yet, but we're underwater like we were. Last one got stopped out. But again, with the low volume, and remember, we saw this before. When it seems like the market will never stop going up, just about that point where it feels like it will never stop going up, that technical analysis doesn't work, fundamentals don't matter anymore, that's when the top comes. Same thing on the bottom. When it feels like the market will go down forever and will never find a bottom, that's when it bottoms. When the last person capitulates, the last long throws in the towel, last weekend along, the last latecomer short jumps in to short the market, that's when a bottom comes. And so I think we're there. I can't make a bang up case, but I can tell you this now. If you recall, I mentioned, on the way up here, even before we hit the lows, this is a typical Fibonacci retracement area for a counter trend rally. What we have here to the left of the chart are the 32%, 38.2% Fib, 50% Fibonacci retracement, and the 61.8. That's from the move from the highs. That's what that line measures down to the lows. And so that is doesn't mean we have to stop there. It's just where a typical counter trend rally, if that's what this is. In other words, if this is the first kickback rally in a much larger move down, then this is run-of-the-mill kind of stuff here. So I wanted to mention that now. And again, we've hit it just for the first time today. We've kissed that 61.8 fib, pulled back a little bit off the highs. So we'll see. We'll see if that plays out. There are still divergences on the 60-minute chart. Let me jump over to that. I told you we won't spend a lot of time here. You can see this is our divergence line. So we had divergence here. And it's not that it didn't play out. It just didn't play out for much of a correction. There's your pullback off that divergent high. The divergence was then extended to this point. Oh no, I'm sorry, we didn't make a higher high, so that's not negative divergence. Right now we have roughly equal highs on the indicators, both the PPO and the RSI, with higher highs. So this is our divergence line at this point in time. That's the divergence on the RSI, and the PPO divergence extends back to this point here. So we have divergent high 1, 2. And again, I'm sure it'll play out at the very least for a little correction, but it could play out for a lot more. The larger the divergences go, the larger the scope of the divergences, typically the larger the move down. And I can say this, nothing has changed on my downside targets for this. The only thing that has changed is we've moved up higher. I think bullishness has gotten too lopsided. Therefore, if nothing else, I think we get a bigger drop than a few weeks back here when I was calling for a 5% drop or so. Now we're looking at probably a 7-8% drop if my targets are hit. All right, on to long-term charts, and we'll wrap this one up. All right, we're going to toggle between a weekly time frame and a 6-day period. Weekly meaning each candlestick, that's what we're looking at right here. This is a 10-year chart, 10 years of price history. But on this charting platform, TC2001, Shortcoming is you can only go back on a weekly, at least on the version I'm using here. I don't know if they've come out with a, I like running an older version that actually works better than the newer ones where they integrated a trading platform that I don't care for. So this one goes back to when I jump to a 6-day chart, I can go back and cover the whole bull market. So what I have are, as you can see, 3 trend lines. Let's just pull these apart. Let's take this one down, and this was the most significant. This was more of a our current, we'll call it the shorter term time frame. It was still going back to 2015. It was a multi-year trend line, and you can see it gave a clear sell signal when that was broken. A lot of reactions. On the scale 1 to 10, this was up there. It's close to a 10 because there's a lot of clean reactions, negative divergence on the weekly, everything I want to see. I don't have all the annotations. I'm keeping this chart pretty clean here. Then we had, and still have, and this is the one to watch right now, I think, we have this one. It comes off the lows back in 2010. Because remember, the 2008 meltdown, and then we had the bottom came in 2009. Technically speaking, QQQ and the Nasdaq 100 bottomed back in the fall. Every other index, including the S&P 500, small caps, mid caps, they all bottomed in March. So call it what you want, call it a double bottom, but I'm just going to use the March lows right now because that's when everything else bottomed other than QQQ. And so what happened, what I was getting at here, just like most major trends, especially to the downside, you had that final capitulation meltdown. You can see it right there. That's where everyone just, puked up the last of their stocks, the last of the weak-handed longs. That's capitulation. That is just like what we had on a smaller scale on the daily chart heading into the lows in December. And so therefore, what I'm getting at here is that's what I also call a momentum fueled overshoot. So that's fine to have that trend line like that. That was just a little bit, this rubber band got stretched too far, pendulum swung too far to the other side. So there's a trend line to watch, and if we use that one, we bounced off it at the lows recently. And so that's one to keep an eye on. You can see the reactions that I'm going off of here. Make sure to use log scaling. If you don't, you're going to get a different picture. This is what the QQQ looks like without log scaling here. Let me put all my trend lines back on. And then I have, of course, this one, which comes in, cuts that low in March of 2009, catches the reaction low back here in early 2016. And then also, and I'm referring to the white trend line here. I'll move it around so you can see a little better. Let's pull those other ones away. All right, so that you can see that's a clean. This is our probably the most significant trend line there is because that captures the entire bull market from the lows, reaction 2, reaction 3, reaction 4, and then when we zoom in, you had several reactions there, and then when it broke with a big impulsive candle. That helped to validate it. And then we came back up. We're a little bit above it now. Sometimes you'll overshoot these. And like I said, you got to give check marks to the bulls right now, or to the bullish case, I should say, because that line has been recovered and that other trend line held. But sometimes we see this, we see a breakdown, a little kickback rally, you may briefly overshoot and then continue lower. But I have to say this, I don't think the market, if the case is to be made, a solid case that a new bear market started at the highs recently, I think this market needs to turn down soon. Otherwise, it's going to see new highs, and that doesn't mean that if we see new highs that it can't then pop new highs and turn around and go down. Anything's possible. That's all I'm trying to say. I don't want to try to sit here and cover a myriad of possibilities because anything is possible. Let's go. Let me put these trend lines back. Again, you can replicate those, and just to show you once more the different picture. Okay, now I have all the trend lines in place, and there's arithmetic scaling. Paints a completely different picture. Some traders use that. I feel strong on log scaling, especially on long-term charts, because you have a big price differential. In other words, back here, QQQ was $30. So a 10% move was what? 3 points, right? Back and when you get up to, let's just say we got up to $300, a 10% move would be 30 points. Big difference. That's what log scaling corrects for you. It puts all these candlesticks in percentage moves, not point moves, and therefore they're even, and you can get a better trend line draw on long-term charts. All right, let's dive into the components, and we'll wrap this up. I want to make a case or just really go over how these all look. Here, let me go back here. QQQ. I have my watch list right here. So here's what we'll be doing. You can see I've sorted these by market capitalization. So we're just going to go down and look at the top holdings, because the top holdings, when we go down the top 10 or so, you're covering, I believe, over 50% of the returns of QQQ. So it does not matter where the bottom 50, 60, 70 stocks go. The stock market will go where the top 10 or so components of QQQ go. There are also, most of those are also the largest top 10 components in the S&P 500. All right, so let's start with right now, the big dog. Amazon, Apple, Microsoft have been scrapping it out in recent months for the title of the world's largest company by market cap. Right now, Amazon still holds that title, I believe. And this is a weekly chart. Pretty clear to me. There's an uptrend line. There's the drops that we had with the last divergent highs, 31%, and I wrote more to come. Why? Well, again, you can see the negative divergence, and what stands out to me on this chart right now is this trend line. We have a trend line off the lows, and we've come in, we've broken down, and we're back testing. So this is, again, the largest company right now by market cap, one of the top holdings in the Nasdaq 100. This is a simple breakdown back test. It's also below that 200-day or 40-week moving average, or right on it, which is a 200-day. I told you we'd focus on the weekly charts, but there's just two stocks I want to look at the daily. Amazon is one of those. Let's go to the daily right here. Let's see what happened with Amazon. So here was a divergent high, and here was a rising wedge. This triggered the big correction that we had in Amazon. It was very clean. This is, again, where I talk about how sometimes technical analysis works so well, it's almost uncanny. And if you're not a believer in TA, if you're new to my YouTube channel, new to the site, and well, I'm going to show you something in a second that makes the example of how well technical analysis can play out. So you can see the rising wedge. You can see the breakdown, and sometimes you break down from a wedge and that's it, and you go down, and sometimes you come in and you kiss the wedge. We call that a back test. And then you can see from there, we felt about that 341.65 area. Oh, remember, there was a meltdown into the lows, so we had what I refer to as a momentum-fueled overshoot. We have a lot of velocity or momentum coming to the downside, so we overshot my target of 341.65 by a penny, and you can see we closed right on. I have to zoom in so tight. There was a doji there. You can hardly see the body. The doji means we closed right on that level. Now, this was when Amazon was at all-time high, so I'm going to show you a chart. Okay, and this is Amazon back then. All my charts on the site are time stamped. This is September 17th, and I was watching this wedge saying a sell signal will come when we break, and we got it. And so on September 17th, I said Amazon cracked below there, and I showed the path. I outlined my targets, and this was my final target, 341.65. So that's technical analysis. Fundamental analysis is not going to give you such precision to project where a stock is going. Now, my point here is that was expected, and so was a counter trend rally. All the arrows aren't drawn here, but if I have a final target, that's where I expect a reversal. And of course, at the time I said it. So again, where I'm going is right now, as powerful as this bounce is, and as convincing as this bounce is to the masses, it was projected and built into the technicals, as was the move leading down before it. And I said this too, I would have a harder time zeroing in on the exact bottom, as well as where this bounce is going to go. We're starting to stretch the upper ends of my range where I expected the bounce to go before it even started. And I have to say that I am surprised that we haven't had a decent corrective wave since this bounce started. We had a little one early on, but again, that's, as I wanted to show you. Most importantly, forget about what happened. I just want to outline that it was priced in. But where we're going from here, we have Amazon at quite a bit of resistance, downtrend line. And again, let's focus on this weekly chart, breakdown back test. And I do believe more to come. When I look at a lot of things here, I can see this PPO trend indicator. The 9 EMA is below the zero line, as it was back here and here. And remember, there's a couple things. We are over 10 years, roughly 10 years into the second longest or almost the longest bull market in history. So we know that eventually we're going to have a recession, we're going to have a bear market. You can say that, well, we could have had one a year ago, could have had one 2 years ago, but also when we had that last sell signal on Amazon, big correction back here, I didn't measure the move down. We had divergent low. We had bullish divergence. That's one thing that's lacking right now. We don't have that. We also had a divergent low right here. So you can see the only other times since the bull market began, and this is again a 10-year weekly chart, we had these dips down below where that trend indicator went bearish, went on a sell signal. We had substantial corrections in Amazon. We had bullish divergence. We don't have that now. So even if you want to make the case that the market's going to new highs and beyond in 2019, I think there's a very good chance we come in and undercut those recent lows to put in a divergent low before we do so. We don't have to have that, but I can tell you it would look a lot better. And I can also say right now, say what you want, but we're going over these weekly charts like I did the monthlies yesterday because these are long-term trend indicators and they are bearish. And make no mistake about it. You're below the trend line. You're back testing from below after a breakdown, and that trend indicator is bearish. So I spent a lot of time on Amazon, as I should, because it's one of the top components of the Qs. Okay, and we can move through a little faster now. So like yesterday's video, I'm just going over a few things, trend lines, any key moving averages. On yesterday's video, we were focused on what I believe the 20 period monthly exponential moving average on the monthly charts. On this one, what does a good job, on some stocks better than others, is the 40-week exponential moving average. That's the same as your 200-day moving average. And it does a good job on a lot of stocks, especially tech stocks, of acting as support, as I'm showing you here, all these tags during an uptrend. And then once you're in a downtrend or a bear market within that stock, it acts as resistance when tested from below. Get back above it, you're in an uptrend, and you want to buy pullbacks to that level. When you start going down and you're in a correction mode, you can see all the corrections. These came after divergent highs. You want to look for bounces back to that level. And so it helps to define the trend when you're above or below, number one, and also offers objective long entries on pullbacks. And sure, like any moving average, it's just a single, simple one indicator. And again, it works better on some stocks than others. Sometimes what I'll do is tweak it. If you're here, and I'm not going to play around right now, pull down that EMA, open the settings, and try a 39 period. If you see Apple, it's doing a great job here. But sometimes it slices through, maybe change it to a 41, 42 week. That's what I'll do and try to find a perfect fit because every stock, again, is a little different how it behaves. But with that being said, I've used this for many, many years, and it has done, and even beyond this 10-year chart here, a phenomenal job, about as good as any one simple indicator can. Remember, it's just one moving average. It's done a phenomenal job of defining bull and bear markets or primary trends in Apple. And you can see since the last, once we recovered here, there it is. It's been bullish. So Apple is, by all accounts, make no mistakes. Do not get tied up in how strong it's rallied just in recent weeks. What it did after earnings, it is clearly on a sell signal and bearish, well below that 40-week moving average. Does it mean it can't just go right on through it? That's possible, but going back, and again, for many, many, many years, odds are when it comes up to that level, it'll at least have a reaction, had a little reaction there, then it gained it, then it got back above it. But a lot of times during bear markets and bearish trends, it will fail. So Apple, again, at this point in time, by that metric, is bearish. It also broke, as you can see, a very well-defined primary uptrend line that comes off the early 2016 lows, had a lot of reactions. It was very clear. We had divergent high. So a lot of check boxes that say this trend indicator is bearish, as it was here. This is when you don't want to be an Apple. You don't want to be an Apple when that PPO signal line, the 9 EMA, is below zero. It's telling you the trend is bearish. Be out. And when it's above the zero line, like here, that's when you want to be long. So these are your bullish trends. That's your bearish trends. We did hit oversold. So, nothing goes down forever. You get oversold, and that's usually a good time. It's proved in the past a good time to buy Apple, even if it's for just a bounce. See, back here, we hit the oversold. We almost hit it. Came very close. on that big move down, and there was certainly a trade to be made. But then we went back down again, and we put in a series of higher lows on the RSI and the PPO, positive divergence. Did the same here, positive divergence, and then you bottomed. So that's what I think best case scenario. My most optimistic outlook for Apple would be a rejection soon, either before, around, maybe slightly above the 40-week moving average, come in and do something like this and put in a divergent low, and then maybe set up for a multi-month swing trade at that point in time. That's Apple. Next up, Microsoft. Again, one of the largest components of the Nasdaq 100, one of the top biggest stocks in the world. What stands out to me, just a very clean uptrend line that was broken, back tested. We hit support. This was my first target, swing target in Microsoft. You can see that we hit that level, we bounced, nothing goes down forever. This one still has that trend indicator bullish right now, the 9 EMA. But the lines look like we were getting a crossover here, a bullish cross. We started to see the PPO line curl up, but it's starting to now roll over, flatten out. So we'll watch this. Here's one. There's two things I can tell you. Keep it very simple. The next major sell signal on Microsoft will come on a break below that 97.50-ish, we'll call it 97 level, as well as a cross down below of that signal line, the 9 EMA, down below the zero line here. Here's Alphabet. And let me say this, and I said it in yesterday's video, I try very hard, as I showed you in the beginning on that Qqq, showing you a trend line that's still coming into play. I try very hard to, if I'm making a bullish or bearish case on a stock, I try to find the other side of that. And if I can make an equally strong or a pretty decent bullish case on a stock that I'm looking to short, then I back off. There's a better fish to fry. I can't make a lot of decent trend lines on Alphabet. I mean, I'll draw this one here. Maybe it comes into play. We only have a few reactions. It's kind of sloppy. So I'll leave that there on my chart, but I really don't put a high weighting on that. To me, this is a very clean trend line. You can see all the reactions that we had along this trend line. So this is TA 101. This is a big pattern. This is multi-year. This is going back to 2011. This is your primary bull market uptrend line for Alphabet. Lots of reactions, and just, to me, just textbook technical analysis. Breakdown, back test, and so far we're still above trend. So we're below that trend line, which puts the technical posture bearish, and it happened after a big divergent high. We had this price channel here where Alphabet was trading, big negative divergence on this weekly time frame. We never even reached oversold on the RSI, and so my guess is more downside there on Alphabet. That one clearly looks bearish to me. Facebook, like I've been saying, this was the most bullish on the daily time frame, the most bullish of the whole group of what I call the FANGs, FAAMG, those top heavy components of the Nasdaq 100. The chart isn't really that clear to me. There's a couple trend lines that I don't want to force. I talk about that a lot. It takes, in my opinion, at least three reactions to validate a trend line. And these were all close together. I'm not talking individual candles. I treat a cluster of reactions as one reaction. So there's one reaction, two. We never really had much of a reaction here. We went through that trend line, as you can see, without a reaction at that point. We did have a reaction from below, but again, we never had that third reaction to help validate at that point. And then we shot right back above it. So I'm just going to tell you this. I've had this trend line here for a while, not putting a heavy weighting on it. Here's another one I had with a couple, 1, 2, 3, and we'll call that 4. So this is probably the best trend line that I could draw on Facebook. And we have a little more upside till we get there. The trend indicator is clearly, that PPO, clearly in bearish territory, trading below the zero line. So all along here it said the trend is bullish. The signal line was above the zero line, that dotted line. You want to be long Facebook, and now it's saying no, it's saying otherwise. Intel. Intel, largest chip company out there, so the leader in the industry. Here's another example of technical analysis. You can see I have two levels on my chart and two percentage numbers. Now I said 24% hit, 26 total. Why is that? That's from the highs to the lows. What we have here are clean. You can see the history on this chart. All these numbers, these percentages, are the drops from the highs to the lows from divergent highs. A lot of times you had a minor trend line you can see, or a wedge type pattern, and so we had a 28% correction. I talked about this yesterday in the other video on the long-term charts. These, you can call it a bear market if you want, that's semantics. These aren't bear markets to me. These are just simply corrections in an ongoing bull market. Semis move a lot more. So a 28% drop, although it met the definition of a bear market because a drop of 20% or more off the highs, no. When you look at this chart, this is a bullish trend, and these are simply corrections. Yeah, they're powerful corrections. You make a lot of money shorting a stock that drops 34%. So far off the highs, we had this very clean bearish rising wedge. And remember, this is not hindsight stuff, nor are these targets. This is technical analysis 101. Let's look at these targets. Remember, 42.59 and 38.27. I was calling for, before this wedge even broke, I was calling for this, and I still am. So this, I believe, is initial kickback rally. Let me show you that chart. Okay, this goes back to timestamped January. That may, oh yeah, no, I screenshotted it. Here it is. We have to look. This was a screenshot of a video because I covered this one in several videos. May 30th, 2018. So that whatever video I published back then, and in that video I had said these were my targets. I was looking for and that was, again, the wedge hasn't broken, so that's why I was roughly 24% based on where it was, but it did break shortly after that. So same levels that I just showed you, and I expect nothing different. I expected a move down, the primary first wave coming down, my first target 24%, and the same reason that I list multiple targets on the official trade ideas on the site is because I expect a reaction off each target. Otherwise, I wouldn't list T1, T2, or T3 if I have 3 targets. T1, if you want to take quick profits, even reverse a trade and then get back in. But if you're a long-term trend trader and you want to hold out, I still think, and I feel very confident, that Intel is headed to this level before 2019 is over, and that's 38.27. That'd be my final target. At that point, if the charts told me to, I would probably be interested in tucking along away for quite a bit of time, several months or more. But again, we'll see what happens when the charts get there. But as of now, let's get back to the Intel chart. Where were we? This is just appears to me to be just a counter trend rally after a bounce off support. Okay, I'll wrap up here. I'll just show you a few others that I have as I go down the line. See, remember, once we get down past the top 6 or 7, the percentage weighting really starts tapering off, so these stocks don't have as nearly a big as of an impact. Cisco, you can see, just clear, again, the charts are very clear to me. It's just getting this short-term timing, trying to time when this counter trend rally will end. But you can see, I can tell you, I showed you a lot of stocks with a little more upside to go, just a couple percentage points, until they back test major trend lines or key moving averages, Cisco being one of them. So this is a bearish rising wedge pattern in blue, breakdown, impulsive too, which helps to validate that breakdown, kickback rally to back test the wedge, again on a weekly time frame. So it's hard. You don't use weekly or monthly charts to hone in on your entries and exits. That's what I've been trying to do with the 60-minute charts. It hasn't worked out yet. We caught most of the run up, and now I'm trying to, position for the next, what I think will be another wave down. And as I said, there's still some work to be done. I can make a bullish case on some stocks right now, as I did on yesterday's chart in XLK, or yesterday's video on the monthly charts. Here's a trend indicator I want to see flip down to bearish at Cisco. Comcast, there's your primary bull market uptrend line. Again, you can see there's a 2009 lows. There's a bull market uptrend line. There's a breakdown and what appears to be the first wave down in a new bear market. That was the first wave down. Second wave is a counter trend bounce, and probably a third wave down to come. And maybe we'll get a nice little EW5 wave count coming up soon. So again, long-term stuff here. And we can go on and on and on. PepsiCo, it doesn't get any better than that. I look at this chart, and these lines are not forced. This just jumps out to me as a very, very well-defined trend line. This is not random coincidence trying to draw these lines. There's a lot of reactions. This stock, since the 2009 lows, has had numerous reactions. There was a little flash crash. A couple stocks back in 2015 If you recall, I was trading at the time. Quite a few had a mini crash that day, so you'll see some of these errant candlestick shadows or tails there. But we closed right back above it, and then boom, 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 broke down, back tested again, back tested again. We remain below trend. So that's it, and we just need some of these trend indicators. So that's what I'm looking at here. And so I guess where I'm trying to go with this, if within the next, let's say, month or so, couple months, we get another thrust down. We don't even have to undercut the lows. A lot of these stocks that haven't had some of their longer term trend indicators roll over will roll over, and will further confirm the case that this is most likely, or this was most likely, a bear market rally. All right, we'll leave it here. This has been Randy Finney with the right side of the chart. I hope you enjoyed it.